Hello. So far I've gone over writing puts, covered calls / deep in the money covered calls, and vertical spreads versus diagonal spreads. Next I'm going to go over the risk reversal, which is also known as a synthetic long, because we are effectively positioning the same as being long the stock, but without having to actually own the stock. This strategy is a bit more speculative, with more potential risk, but also unlimited potential upside and limited, if any, initial capital cost. So for this strategy, we want a stock that has a lot of upside potential, but hopefully not much downside. Again, I'll take a look at my stock screener, and I'm going to look at some underperforming technology names that are near lows with gigantic upside if they report well on earnings. Even with options, you want to diversify and balance out your risks. So you may have noticed that I've chosen a different sector for each one of my options videos so far. So if we have a look here, there are a few names that stand out to me, but I'm going to choose SanDisk. It's come down to less than half their 52-week highs on recent disappointing earnings reports. And I won't go into detailed fundamentals or technicals because that could be a video in itself. But I think if their earnings are positive, we could see a nice jump in the stock, and I don't mind owning it at these levels. The first part of the strategy is selling a put. I'm going to choose the July 24th expiry right after SanDisk earnings and the strike price of $53.50, which is directly below or basically right at the current stock price, which is $53.53. I can collect about $2.26 in premium, assuming the middle of the bid ask. So this means I will get paid this amount per share to buy the stock on July 24th if it trades below the strike price, which I wouldn't be opposed to. Next, I need to buy a call, so I'm going to choose the next strike price up at $54. I don't want the same strike price just in case the stock trades around these levels, around expiry, and I have two legs to worry about closing. The long call is going to cost me $2.10, so I'm paying a little less than I'm receiving. On to my options calculator, and I'm going to choose 400 shares. That means I will collect about $900 in revenue and spend just under $850, so I get a little extra money for putting on these positions. Now if the stock closes between the two strike prices, between $53.50 and $54, I keep this money and the trade is done. If the stock closes below $53.50, I either close out my position or I get exercised and get the 400 shares of stock. And that would cost me $21,407. My break even would be $53.38, so it's a little bit below the current market price. Anything below that and I'm in a negative position. So again, it's just like owning the stock, but a few cents cheaper. Now the upside is that should the stock rise above the $54 strike price, which is less than 1% above the current price, and I believe the stock could potentially rise up to double digits after earnings, you get all of the potential upside with no capital down. In fact, you actually collect a little bit. You can use this strategy to play events like earnings, or for further out expiries if you want to own the upside in a stock, but maybe don't have the capital available right now to own the stock. Again, this is more speculative, but if you are prepared for the risk reward of a stock, but don't want to actually own it, this is a fantastic strategy to use. Thank you for watching. I hope you enjoyed it and that you can use this strategy to your benefit. Follow at Daytrade Canada on Twitter. Visit the website and please share.